This is Scott Richardson, President and CEO of Izale Financial Group, and I want to welcome you to the final series of webinars for us for 2020. Today, the topic is balance sheet optimization in driving performance, and I am very pleased to have, really as the main presenter, not so much a co-presenter, my friend Todd Taylor. Todd is the founder of Taylor Advisors. We've known each other for about 20 years. And I've enjoyed the conversations with him about how a bank or a credit union can set up their investment portfolio. He understands BOLI is not necessarily adverse to that process, if you will, and vice versa. So there's a good respect in what we do. His firm is based in Louisville, Kentucky. He's got a little bit of a twang, but you'll appreciate that. And he does balance sheet consulting for financial institutions. They have 100 plus clients in 14 states. He does a tremendous amount of speaking at state associations, institutional conferences and whatnot. And he does publish a series of articles. And if you follow our blog, we do capture those from time to time and put them in there just because we find them informative and helpful to folks there. So he and his colleague Omar are going to spend the next 30 or 35 minutes kind of presenting there, and then we'll kick it back to me. So I am going to make Todd the presenter and let him chat.
Thank you. Scott, appreciate the introduction and glad that we've maintained our relationship, and welcome to everybody that is joining us today. Glad that everybody is able to carve out some time today. Our session, we're going to go at a fairly quick pace, but it'll be recorded. We'll make it available through a link later if that makes sense. And the title, again, Taylor Advisors, again, we're a fan of, helping provide education and analysis by providing advice, strategy. And again, this education session is really focused for you guys. And again, we know we have credit unions, banks, financial institutions, so we're going to speak to all of you guys. So as the title mentions, balance sheet optimization, trying to get the most out of your balance sheet. And again, driving profitability, that's very important to all of us going forward in 2021. So, so let's kind of get, focus on something as you see on your screen. What has happened to financial institutions over the past 35 years, right? Mergers of equal, acquisitions, even failures, and even a lot of credit unions have acquired actually several banks kind of in the Midwest region. And as you can see, that's declined over time. Will that continue? Well, for some, right? Shareholders are getting older, succession planning, and maybe just a time to cash out. But for the people who are here today, they not only want to survive and thrive. So this is the time where people are trying to come up with ideas, right? Doing SWOT analysis, mobile banking, exploring different deposit and loan products, trying to get that edge. And that proverbial strategic planning happens about this time of year or early next year. So let's take a quick look at some of those and are they successful? So as you can see on your screen, our latest initiative takes a three-prong approach. And as you can see in the cartoon, poke, prod, and jab. Again, will that work? Maybe short term, but not only will you lose customers, but a few employees along the way. How about one more? What if we don't change at all and something magical just happens? Crossing your fingers and having a strategy on hope has never worked. But really, the magic might really be right underneath our nose. So as you can look on your screen, what are the benefits of a strong ALCO process? It leads to higher net interest income, higher profitability, maximizing shareholder for banks, and also maxing net worth for credit unions. What's misleading is do not assume immediately that ALCO is about interest rate risk management. That's far from the truth, and we'll unpack that later. Thinking about a different approach, a different focus, because our industry is evolving. We've heard a couple of consultants talk about this idea. There's a high correlation between highly effective ALCO and balance sheet management and high stable margins over time. That is a true statement. However, some people, not the ones on the call, executives saying, hey, my margins are down because of the competition in the local markets. My margins are down because of the shape of the yield curve. Well, don't we all swim the same waters, right? So what are we doing trying to outperform? So today, kind of a quick takeaway is that why is ALCO so important to profitability? Number two, we talk about custom strategies. so valuable. We got credit unions and banks. Some are asset liability sensitive. Some balance sheets are more complex than others. Again, the idea of a one size fits all is flawed. We got to be very institution specific. And today, all those people that got on a little earlier, you have your own performance snapshot that Omar and I are going to refer to down the road. So before we talk about balance sheet management, let's set the stage a little bit about the rate climate. So if you look at, you've heard about the dot plot, maybe, or a few of you may have. One dot, one Fed official, one vote. As you can see, as you move from left to right, we actually drew a line and tried to average that. Notice there's a dispersion among Fed officials, right? They have different opinions. They're not always on the same page. And also notice that it's upward sloping. That was at the end of December of 2019. What happened? COVID hit mid-March. We had a 150 basis point cut in 2 moves, and it wasn't even during a regularly scheduled FOMC committee meeting. So today, where is the dot plot? Do you notice there's not as much as a dispersion? They're on the same page. Very little change in short-term rates for 2022, and a few outliers in 2023. The reason why we want to bring this up, at least initially in your ALCO, you need to plan on the fact that rates are going to be lower for longer. Let's talk about the shape of the yield curve. As you can see on your screen, and also I show on here where the Fed funds futures are, that's where the market's expectations today do closely align where the Fed officials are. So I want to go ahead and take a look at the yield curve. Let's look at it from a year ago in December 2019 versus today or December 2020. And you can see on your screen, see those little orange stars? Think about all the institutions. You all have a lot of earning assets pegged all along the yield curve, from loans, from cash, from different security types. Additionally, you'll have a lot of funding costs, shared certificates, FHLB borrowing, savings, MMDAs, right? And now look at the change. So now the yield curve is a lot lower. We need to come to the realization, and a big challenge that we all face is that earning asset yields have peaked. Why? Rates are lower. Competition continues to be fierce. Loans have slowed, but also spreads may have tightened. Notice that short-term rates on the long end will more than likely be anchored. And we like to say is that a lot of financial institutions have been slow to get relief on the funding side. So earning asset yields have peaked, slow to get relief on the funding side. Let's take a look at a handful of headlines. Even though we have credit unions on here, this gives you a little proxy of what's going on with the industry. And this is a culmination of equity research headlines. But I want the participants today is to kind of focus on the words in the red lines. Rate challenges, NIM pressure, NIM contraction, slippage. And that's not just to community or publicly traded banks, but for community credit unions and community banks, what they are facing. And I don't want to insult a group of executives, but I think we got to go back to the basics here. You know, let's talk about how do you guys make money? Think about interest income, or it's easier to say earning asset yields in dollars, right? You know, what are you earning on your cash, your securities, on your loans? Less that interest expense. What are you paying for? Or that cost of funds in dollars on those shared certificates, the MMD accounts. That's net interest income. That's what Omar and I want to focus on. Yeah, do you all have other income? But it's very small. Think about your own institution. Do you all have a huge wealth management division? An insurance agency? Not likely. If it is, it's not significant. Yeah, some of you all are enjoying the secondary mortgage activity, but is it sustainable? I know y'all are more probably very prudent on operating expenses, such as payroll, technology, and advertising. So you can cut that and get a short-term benefit, but you have a long-term consequence. What am I trying to get to? Net interest income is where you need to live when it comes to balance sheet management and how you're going to continue to kind of outperform. So the saying goes, the more net interest income dependent your institution is, the more net interest margin will drive earnings. It matters. So I want to share with you a national conference that I did, and we want you to look, and we're doing this for banks as well as credit unions. We want to show you the actual net interest margin change since the end of December of 2019. 7 out of 10 banks experience margin compression either on a small basis or even north of 30 basis points. You know, could it be from PPP loans at 1%? Omar's going to talk about cash drag has been quite painful. What about your institution? Were you more asset sensitive than you expected? Rate modifications, floating rate loans, and again, slow to get relief on the funding side. Does this picture look significantly different from credit unions? Absolutely not. Close to 80 institutions have felt some of that compression, right? So what do we want to try to do today? We want to go ahead and try to share with you on your own peer analysis a little bit on net interest margin and net interest income dependency. So hopefully you'll be able to pull out the sheet that was sent last night. And first we'll talk about banks. As it comes out, think about net interest margin dissection, right? What are you earning on your investments and loans and your mix? In this sample bank, you can see they're behind, they're in the 9th percentile versus UBPR. They have some room to improve. Are they average in the ALCO process? It also shows net interest income dependency. So we want you to bring focus and clarity about the importance of net interest margin. Let's take a look at the credit unions. Similar snapshot, a little bit different information. This institution is margin is, and we only can have state credit union information, not UBPR. Again, they're in the 14th percentile. This institution or credit union might try to figure out how can they get a little more relief on the cost of funds side. So the takeaway is studying your margin over time will be a key component. Again, when we think about a bank and we talked about net interest margin and how ALCO can impact it, let's go back in time and let's see how it all got started and what has changed or evolved over time. So Omar and I did this presentation called The Evolution of ALCO. And over since the 1970s, we always said pain promotes change. So let's go through a handful of these things that take place. Let's go to the 1970s, the introduction of the first interest rate risk tool, the gap report, heavy on estimation, a lot on repricing, and a lot of that information was slotted. There was some value, and remember, personal computing was just getting started. In the 1980s, an enhanced interest rate risk metric called earnings at risk. Most of us can relate more to dollars than just a ratio, and it's a little bit more easier to digest. Investments is, in the 90s, you can think about the birth of the financial engineer, and Wall Street started creating some exotic investments like the CMOs. In the 1990s, in the savings loan crisis, rates went up and they stayed up. So a third interest rate risk metric, present value of equity, economic value of equity, and each one of these have some level of interpretive value. Some are better at measuring short-term interest rate risk management, some longer term. Market value shocks were important for investments because when rates went up, these exotic investments dropped more in value. They had structured notes and support bonds, and liquidity was very valuable because it brought a comprehensive approach. When you talk about in the 90s and 2000s, default assumptions were a big focus, right? Canned and generic. Again, a lot of the regulators had that information. Cash flow volatility was bigger. Liquidity stress testing took center stage, right? Modeling mild, moderate, significant stress testing. Then we got to be more bank-specific assumptions, right? Loan level detailed, security level detailed. It's great because we get to be more customization was key. Independent muni credit analysis was valuable because remember the Big Short, right? Can't rely solely on third-party rating agencies. We learned a lot about the subprime market. And finally, COVID's hit, more stress testing assumptions, capital stress testing. Who would have thought of balance sheets growing against their will and the capital kind of ticked down a little bit just because balance sheets had ballooned? So what's the takeaway? The expectation is we need more and more is expected among the regulators, better tool data, better tools, but there is an onset of a paradigm shift. Regulatory appeasement is important, but when we go ahead and look at the survey, what we have found, a lot of community institutions want to also focus on this idea of profit improvement. And so people ask us this question on time, where should we spend the most time? Well, the primary objective is how to maintain or improve profitability. The byproduct and the documentation typically follows a close second. So let's talk about a handful of some common ALCO approaches. Always jot this down. Two things to consider. What is in the ALCO packet? What information do you include? And secondly, how's the facilitation done? I'll never forget, we talked to a CFO, a new client in Nebraska. She had a confession. She says, I'm guilty. I feel like ALCO is just a regurgitation of information, but now I realize I need to do a lot more. And what should my ALCO packet look like? So what we're going to do as an illustration is walk through 4 different types of ALCO packets and ask yourself, does this sound a little bit like me? What do I underweight? What do I overweight? And what do I completely miss? And these are just examples. So a sample of this one, the facilitator spends quite a bit of time on the economy and rates, retail sales, industrial production, and going back to history on inflation. Yeah, that's okay, but it leaves a little time for interest rate risk interpretation and maybe talking about liquidity. We call that the economist approach. And as you can see on your screen here, again, there are a lot of economists, a lot of Fed chairs over time. But the end game is not trying to provide excellent economic commentary to the ALCO committee. It's flawed. Don't be careful not to overweight the economic session and make sure you don't miss key ALCO areas. Let's talk about another one. They spend a little time on the economy and rates, which is perfect. Then they overkill pricing. What type of pricing do I mean? We're talking about deposit pricing and loan pricing. It really cuts short the amount of time you talk about the interest rate risk position, or maybe cover another position that might have been completely missed, like capital. So when do you get a chance to talk about pricing? This is the pricing approach. There are lots of opportunities. Yes, do I believe that you should spend some time talking about deposit and loan pricing and ALCO? Absolutely. But what are the other opportunities? You get the opportunity to talk about pricing. Customers, proposals, you send emails, prospecting, even hanging out. But what about you have your own deposit pricing meeting? It's commitment to that area, right? So you have lots of opportunity to talk about deposit pricing. What about the loan committee? Absolutely, you talk about loan pricing, and also even at the board meeting. What's the point here? Again, we love ALCO should incorporate some level of pricing, but again, the downside or the con is that if you embrace this approach, I think you miss the opportunity to drive strategies and earnings. Does that sound like you? The third approach is you talk about the economy and rates, and then you talk about pricing, which is right sizing it, but then a huge amount of time and paper is committed to the interest rate risk tool or the output. I call it ALCO drudgery. People that the chief lending officer, the chief credit officer, are they gaining value out of that? And then you think about the liquidity section. Ask yourself, how big is my ALCO report? Is it 30, 40? I think I heard one institution say 90. I want to show you the world record for the interest rate risk approach. As you can see on your screen, this is just a handful of the pages that embrace the interest rate risk approach. And I wanted to show you the agenda. As you can see on your screen, yes, you are reading that correctly, close to almost 1,500 pages. I mean, it would take you till next Christmas to get through the material. I mean, that's not just one ream of paper, but actually 3 reams of paper. You can't see the forest through the trees. Does that sound like your institution? If it is, maybe you ought to think about something differently. Now, finally, The fourth approach, the economy and rates, makes sense to talk about interest rate risk, knowing that position, even talking about liquidity. But then investment comprises the majority of the ALCO meeting. How does that happen? Sometimes it happens because the interest rate risk report is prepared by a broker-dealer firm, or the facilitator is in a separate division of the broker. Why should the punchline for an ALCO meeting be a bond buy or a bond sell? Hey, we're not telling you should ignore investments. It's a big focus because of the excess liquidity that Omar is going to talk about. But again, the broker approach could be dangerous. The reason why, do you want to take advice from Gordon Gekko? Not necessarily. So let's do a quick recap here. Think about your institutions. What do you underweight? What do you overweight? Are you missing any key areas to the ALCO process? We took a survey. Which area in your ALCO meeting do you typically overweight? And the answer is, people ask us all the time, did you overweight any particular area all the time? And the answer is no. Omar and I like to say there are times during an ALCO meeting, it might be in succession, where you have a slight tilt. But again, ignoring the other different positions could be flawed. The reason why we want to talk about it is when we think about the ALCO packet, the facilitation, we're a big believer of something called position assessment. The position assessment has everything to do about knowing who you are and where you're going. A cybersecurity expert once said at a conference I heard, and I never forgot it, you need to know where your risks are in order to effectively manage it. Well, what about ALCO? You need to know where key ALCO positions are to effectively manage the balance sheet. I'm going to turn it over to Omar to drill down on the position assessment approach.
Thanks, Todd. So let's unpack the position assessment as relates to ALCO practices. We'll kind of kick it off here with capital. Remember, capital is the cornerstone of the balance sheet. Without capital, you don't have a credit union, you don't have a bank. Next, we move over into liquidity. This is the waterway that is driving commerce between your depositors and your borrowers. Next, we move over into interest rate risk. This is essentially the gas gauge that helps you measure your balance sheet behavior as interest rates change. And lastly, the fourth position in that investment portfolio, we kind of view this as the regulator. Remember, this is the portfolio that's going to help balance out all the other risks on your balance sheet that you have difficult managing and controlling. But for the sake of time, we're only going to focus on two elements for today's discussion, and that's going to be liquidity and the investment portfolio. So let's take a deeper dive in liquidity. Many different forms, on, off balance sheet, contingency funding, but also looking at liquidity as a profit center. Remember, we've had a huge influx of deposits that have entered the system as a result of a lot of stimulus coming out of the government, as well as change in behaviors and spending habits from our depositors as well. So as we take a look, on this, we wrote an article specifically on this, kind of highlighting how cash is just not always king. This is a very similar environment that we're in, no different than back in 2009. We're at the very beginning of this low rate environment, and this cash drag is going to be persistently dragging our earnings for years to come. So here are a couple ideas to summarize those challenges. Remember, we've had this huge liquidity flood as there's been an accumulation of deposits at a very alarming rate. Next, moving on into loans recycling. I venture to guess that everyone on this call, your loan operations division has been very busy over the course of this year. And that necessarily hasn't translated into new loan footings. It's mostly been loan modifications and refinance activity. We're essentially just treading water. Next, we move over into PPP loan forgiveness. A lot of us that have self-funded, these PPP loans are going to expect another influx of cash coming onto those balance sheets whenever the forgiveness takes place, which leads us into the last position. Again, the investment portfolio. No different than what we experienced. Remember, secondary market activity has been on fire. So that translates every single Fannie Mae and Freddie Mac mortgage that we refinance and resell is going to come right back to us in the form of a repayment on those exact same mortgage-backed securities that are issued by Fannie Mae and Freddie Mac. More cash coming onto the balance sheet. And the last one, the agencies refinancing their debt. They're no different than the institutions on this call. We're looking to reduce our funding costs as a result so that we can maintain our margins. The government agencies are no different. Again, they utilize the mechanism of these call features and callable agencies, putting more cash on our lap as well. So we like to look and evaluate liquidity ratios for institutions. And the chart that you're looking at here is, you'll notice on the left-hand side, these are going to be institutions that have lower levels of liquidity. You can think high loan to deposit ratios, smaller investment portfolios, and small cash positions. On the far right-hand side, you'll see in the fourth quartile, those are going to be institutions with much higher levels of liquidity, large investment portfolios, large cash balances, very loan to deposit ratios. What we'll also notice is there's an inverse correlation on earning asset yields as it relates to the liquidity ratios that you have. So on the far left-hand side, lower levels of liquidity, more loans, higher earning asset yields. On the far right-hand side, higher levels of liquidity, lower loan portfolios, lower overall earning asset yields. But let's not forget that even though, as we take a look at our balance sheets, we want you all to look at those snapshots again. Take a look at your liquidity position. What is your liquidity ratio? Are you carrying too much liquidity? What is your funding cost? Are you carrying excess liquidity that's putting a drag on your overall earnings? Which takes us into the other side of the balance sheet. As you look at your earning asset mix, take a look at your loans. Are you carrying excess amounts of investments and cash that is continuing to put a drag on your margin in this environment and potentially over the future environment as well? Credit unions are no different. Take a look at your liquidity ratio. Where are your liquidity? Where's that ratio at? What is your cost of your liabilities? Is that preventing a detriment to your earnings stream, which is going to reduce overall dividends for your members and your ability to generate more net worth so you can attract more members? Also shifting over on the earning asset mix. Are you very loaned out? Are you carrying excessive amounts of cash and investments? But let's not forget that we still have to stress test even though we have large amounts of excess liquidity, because this is no longer an academic exercise. We saw a big stress being placed in the financial system earlier in this year when the pandemic started to unravel, and that's going to be no different as new shocks start to enter our financial system over time. So with this, now we're going to shift from liquidity over into the investment portfolio. Remember, this is the regulator on your balance sheet. It's going to help you balance out and regulate all the other risks that are difficult managing. You can't control your borrowers and you cannot control your depositors. So very simple, we ask a lot of executives, what is the primary objective of your investment portfolio? And we're asking the same question to everyone on this call. Is it liquidity? Is it interest rate risk management, earnings, or pledging? Interestingly enough, a lot of the respondents have came back with effectively an even split between liquidity and earnings, with earnings kind of nudging out liquidity with a higher allocation. What is the most important objective of your investment portfolio? And secondly, as we take a look at earnings being the primary focus, if you will, for most respondents, let's take a look at how investment yields are performing. I think what we'll come to find out is that investment yields for banks are compressing at an alarming rate, and it's accelerated over the last several months. Credit unions are no different. When we take a look at our investment yields, very similar, compression well in excess of 100 basis points for both banks and credit unions. But I mean, heck, we all have laddered diversified portfolios, right? Well, let's take a look at some of these portfolios. Very traditional. You take a look at a 1-year treasury note, 2-year agency, 3-year weighted average live CMO, a 4-year SBA pool, and a 5-year step up. What happens to all these assets when rates start going down? Well, the treasury matures and you're forced to reinvest at lower rates. Your callable agency and your step up get called. Remember, the agencies are looking to refinance their debt at lower costs, no different, more cash in your lap. That premium CMO that you bought is now accelerating the prepayment speeds. You're doing lots of refinances, and that's translating into faster prepayments. That's not only dropping the yield on your investment, but also placing more cash in your lap to invest at these all-time low rates. And lastly, that 4-year SBA pool is now floating with that coupon down as well, further putting compression on the overall investment yields. So let's take a look at a couple of investment best practices. The biggest one is going to be the strategy formation. Remember, this investment portfolio is supposed to complement the rest of the balance sheet. So you got to take a look at it, whether it's from a whole bank perspective or a whole credit union perspective. Next, that moves us into the investment mix, making sure that you're in the right sectors that help complement the overall risk profile of your institution, which leads us into the next section, which is security selection. So once you identify the relative value in each of those sectors, now it comes time to actually select and purchase the individual securities. So we want to make sure that we're being mindful of that, you're having expertise in finding that optimal security selection. Not every CMO is the same. Not every agency is the same. Not every municipal bond is the same. So that moves us over in this article that we wrote earlier this year, kind of highlighting varying different approaches to managing an investment portfolio. As you take a look at the list over on the right-hand side, highlighting number 4, one key driver here is going to be the exclusivity to product access. Does your broker have access to exclusive products? You'll be shocked to find out that the vast majority of the brokers out there do not have access to this exclusive product. Mainly because when you take a look at the size versus investment advisors, it's difficult to get access to these. The second one being number 6, the reduction in transaction costs, improving the overall execution. We had a client send over an article and a research piece to us earlier this year as well, talking specifically, that was written by an economist that did a study on transaction costs for community banks. And what he came to find out from his analysis was that there were excessive marks on the majority of investments that were being purchased and sold by banks and credit unions. This translates into lower earnings, lower yields, lower liquidity, and ultimately flows into the overall performance of your portfolio. So take a look as we look at your investment. What is your institution's portfolio yield and what does your mix look like? Well, you got that snapshot, pull it out and take a look at what are your investment yields and how are those investment yields translating into your earning asset yields, which then flow into your net interest margin. Is it adding undue pressure on the overall earnings stream? No difference. We take a look at credit unions. Take a look at your investment yield. How does that compare versus the peer group? How is that impacting your overall earning asset yields? And lastly, how is that flowing into your net interest margin? We talked a lot about liquidity as well as the investments. So let's kind of summarize this when it comes to ALCO best practices. You heard us talk about the economy rates. It's very important to know what the environment is looking like and what the environment is estimated to potentially look like in the future to get a feel for how we need to best position the institution. Next, we go into those position assessments. You heard us briefly talk about that earlier in the presentation. And at the end of the day, when you look at all these positions, you want to take it from different dimensions of time. You want to study the past. You want to get to see how did the environment change and how did our balance sheet change over the last several quarters or last several years. Then that moves us into monitoring the present. We have to know where we are before we can know where we want to go, which leads us into the third area, which is preparing for the future. And that kind of gets us into this whole idea of, what is the difference between interest rate risk management, asset liability management, and balance sheet management? Well, interest rate risk management is just the gas gauge. We talked about this earlier in the position assessment. When you're driving your car, you don't stare at your gas gauge the whole time you're driving. You may stare at your phone, but you don't stare at the gas gauge. Then that moves us into asset liability management. Asset liability management is the inclusion of all the other components that you see here, position 2, position 4, and position 1. And lastly, what gets often missed 9 out of 10 times is this whole idea of balance sheet management. What is balance sheet management? Well, it's the formation and execution of strategies to manage the balance sheet. Again, for those high and stable margins, regardless of where interest rates go. What kind of strategies does that mean that we discussed in our ALCO meeting? Well, it's everything from liquidity to funding to investments to deposits to loans. They are all interconnected with one another in all the balance sheet positions. And the whole objective here is for profit improvement with risk management. At the end of the day, we want to know, are we getting paid for the risk that we're taking? So let's come to some takeaways. Staying in cash is the most expensive that it's been since 2009, and we stayed in that low rate environment for a good part of almost 10 years. Next, liquidity is not an important discussion in your ALCO meetings today. It should be getting more attention as we evaluate the excesses and monitoring those flows. And last, as you kind of look at, you've identified what the appropriate level of overnight cash is determined. Start evaluating the right options that fit your balance sheet that complement the overall risk profile for high and stable margins over time. So let's take a look at some other kind of takeaways. As you look at this excess cash position, identify your higher wholesale funding borrowings. Most of us have a really good year, well in excess of our budget as a result of a lot of PPP fee income, as well as a lot of gain on sale and secondary mortgage activity. Now's a good time to evaluate some prepayment penalties as a way to utilize some of that excess income and set yourself up for a good 2021 and 22 and so forth and beyond. Next, moving on to deposit pricing. Be evaluating aggressively repricing CDs downward. Heck, money market rates are only paying a basis point in today's environment. And oftentimes depositors are going to get a feel for, we've heard banks say, well, one customer left to go look to another bank because they didn't like the CD rate we offered. And they came right back because they recognized that the market had moved. Rates are lower, very low, historically low. And last is you take a look at your investment portfolio. Devise an investment strategy that best fits the overall profile of your institution. Remember, high and stable margins over time. Don't be afraid to pre-invest cash flows in anticipation of PPP forgiveness coming to you over the coming months. So how would you rate when you take a look at your ALCO process when it comes to driving profitability strategies? Would you say you're above average, about average, or below average? A lot of the response we got from executives was more than about 2/3 of them said that they were about average or below average. How do you fit into this picture? Is there ways that you see now that maybe you can up your game, right, to make the ALCO process more effective down the road? Because at the end of the day, it's going to translate into more interest income. You can clearly see just 10 basis points of protection or improvement on your balance sheet could translate into some real money down the road. Real money that helps provide additional buffer in your capital base. Real money that goes straight into your net worth that allows you to support more members of your credit union. So you heard us talk a lot today about a lot of different areas in the balance sheet and different processes, etc. So what I'm going to do is I'm going to hand it back over to Scott, and if we can open it up for questions now, or please feel free to reach out to us. You got our emails there and our phone number. We'd be happy to discuss different ideas in the risk management area for your balance sheet. So with that, I thank you for your time, and I'll pass it back over to Scott.
Thank you, Omar. Let me get my screen here. Omar brings up a good point. I didn't mention this at the beginning. We will answer questions at the end. If you have any right now that you want to post in your little GoToMeeting box, we can accumulate those, and then we'll open it up for some questions here when I'm done. Great introduction and transition. One, as a board member of a community bank, I just learned something that makes me a better board member. So Todd, as always, thank you for your tutelage on those. The last few minutes here is specifically about BOLI. Most of you know who Izeal Financial Group is. Our mission is to help you value people, which we've done through director and executive benefit programs, help you improve earnings, which is primarily through BOLI. We now have over 1.7 billion that we placed in service. Many of you have some of the sustainable fee income programs that we've helped about 50 clients with, and protect assets. So BOLI, and this is just a sliver of the balance sheet, right? The highest and best use, I believe, of taking deposits is making loans. Then it's doing investments, and I would say BOLI is a subset of the investments. So these are complementary, not contradictory, if you will, to what Todd was talking about. And at the end of the day, under the regulatory guidance, you're only allowed to have about 2% max of your balance sheet anyway in BOLI. So there's room for everything in there. At the end of September, we had almost $190 billion collectively reported by over 4,000 banks and credit unions. And as a reminder, what's different about BOLI that we might think of relative to individual insurance is it's a high early cash surrender value. In fact, 100% beginning cash surrender value for what you pay for it. So this dark blue, if you invested $6 million in BOLI, becomes your principal sort of protected from market risk. Interest rates can rise, can fall, not a penny's impact on your balance sheet value. What you're after is the earnings. One of the biggest objectives for the excess liquidity is attracting earnings. That's why BOLI is so popular. That earnings, it's not cash flow. It accrues every month as the growth in the cash surrender value. You report it as other non-interest income. And at some point down the road, when a mortality event occurs or you request a surrender, that turns that back into cash. And it is life insurance. There is this off-balance sheet element, the gain amount, if you will, that you can strategically use to offer a supplemental benefit for your key persons, key people, their beneficiaries, or to protect the institution for key person. But the secondary objective when you look at BOLI is life insurance, not the primary. This I found interesting. What's been happening really for beyond 1995. It's a 30 or maybe a 40-year bond rally, if you will. Interest rates have been trending downward the whole time, and you'll see some spikes. That doesn't escape the impact on overall insurance. So this is not specific to BOLI. This is the entire universe of insurance policies. When we see average whole life crediting rates, average universal life crediting rates, they tend to trend the same way as market rates, albeit as a lag. Still a little higher than most of the shorter term things because insurance companies are able to invest and go longer on a broader basis. For those of you that have BOLI, or even if you don't, you're considering it, what's changed for that market since February? And man, how rapidly it's changed. So some carriers eliminated sales entirely. They said we won't sell to anyone but an existing client. Others have said we want a maximum case size. Others put a premium capacity limit because they recognize that if they get an influx of premium, they have to invest it somewhere. They have their own assets that we're investing, as Todd was talking about. They're maturing or turning into cash in a lower rate environment. If you're an existing policyholder, this is what you want to see, because this is the carrier saying we want to make sure we can maintain a competitive rate for the people who are already our clients, not for people who are about to be our clients. It stinks sometimes as a salesperson, but it's really better for customer and client service. Everybody, no exception, has reduced their crediting rates. Sometimes as low as 10 basis points, others even 100 basis points. They were kind of a very high end, and they wanted to step out of the market without really saying they're out of the market. That was their answer. We even had one carrier who had a really strong product that had a 3% guarantee, which you just can't sustain that in this interest rate environment. So they pulled it. Product will come back in January and it looks dramatically different, almost uncompetitive, frankly. That's new sales only. Despite all that, for all the reasons that Todd talked about in terms of the liquidity growth explosion and the alternative yields being down, we've actually seen BOLI sales be strong. New proposal yields are anywhere between 2.6 and 3.1%. Obviously, how big your purchase is, what type of underwriting you do, full underwriting, guaranteed issue, those kind of things can influence that dramatically. We've got even some enrollments going on now where the yields are 330 and 340. Pretty remarkable. In fact, we're going to have our best fourth quarter ever. If that 2.6 to 3.1% rate, if that current fixed rate is not enough, what do you do besides not buy BOLI? One of the things that we're having conversations with a lot of clients is about an indexed strategy. And I'll talk for a couple of minutes about that. So indexed universal life insurance in the BOLI context is really kind of looks to the S&P 500. And everyone's hackles should have just raised when you think about that, because you shouldn't be investing in the S&P 500 with your capital in a bank or a credit union, because it can go up 40%, it can go down 40%. And in fact, we've seen both of those in this calendar year. So the returns are volatile. In fact, you can't even regulatorily permissibly invest in those things precisely because of that stuff. What IUL does is try to color that. The cash surrender value is never exposed to the S&P. It's just looking to the S&P to measure the change, and it's done in arrears, obviously, because we measure it after the change occurs. So it's still, excuse me, general account BOLI at all times. I'll show you what I mean. This is a real life example of a client. We had the opportunity to actually have the CEO purchase a regular fixed rate BOLI contract and a regular or an index BOLI contract on the same day. So both of them were implemented way back on January or February, I can't even speak, September 1 of 2016. Here's the traditional BOLI, the gray line. Crediting rate's fairly fixed. You can see it's fairly predictable, stays just under that 3% range, coming down a little bit this year with the crediting rate, but predictable, not too variable from year to year. Here's the indexed BOLI. The way indexed BOLI works is you give your money to the insurance company, they put it into a fixed account that's going to get interest, and then 1 month later they take 1/12 of that balance and put it into what we call a segment that starts measuring the S&P. So for 1 year, that segment earns 0%. In arrears. Well, this collaring concept says if the S&P is 0% or below, your crediting rate is 0%. It can never be negative. On the flip side of that, because the insurance company is taking all the downside risk, they have a cap. And in this case, if the S&P for that 1 year measuring period is 6% or above, your crediting rate is capped at 6. So this is the actual crediting rate month by month history for those several years in there. You can see it bounces around a little bit. So it's a little bit more variable, but on average, you can see how over time, and usually about 2 years down the road, it actually passes the traditional approach. So the long view is it puts you in a better position. And here we are, this was through July, we are more than 0.5 percentage point cumulative average difference, and not really looking back for a while. And if I were to measure the S&P with that 0% floor, the 6% cap, if I go back 25 years and I take all 6,000 measuring periods, the average is 4.55%. And here we are, BOLI world today, seeing 3.25% crediting rate, or even less. So it positions you for a much I work with Izael before we open it up for questions. As most of you know, obviously the pre-purchase support, the detailed analysis, the education of your board, the due diligence manual that we summarize everything that's good for you and your staff, as well as examiners. Any benefit plan documents, we give them turnkey for you, so outside advisor time and cost is less. And the post-purchase servicing. So we have our own secure online portal for monthly values for your financial statements, benefit statements, the annual risk assessment, which becomes more and more critical, not only looking at the carriers and their credit ratings and their financial statements, but reprojecting to make sure we don't see any weaknesses in any policies and whatnot from there. But I want to end by saying thank you to Todd for your time, Omar for your time, and your sharing your insights. Enjoy, everyone, and again, be safe. We'll talk to you soon.
Great. Thank you, everybody. Thanks, Scott.